Hello, everyone. Welcome to Commercial Loan 101, real people, real deal, real stuff. How you doing, Miss Suzanne?
I'm good, Jay. How are you?
I'm doing awesome.
Today we're going to talk about term sheets and lender language. Is that correct?
Yes, we want to show our users what a term sheet looks like and how to speak lender's language to get better terms for yourself.
Excellent. I don't think many people are super involved in this process. So what do you got?
Let's go over an example of what a term sheet looks like. So, guys, this is what a term sheet will look like if you were to get a commercial loan. It will talk about the summary of the transaction. So basically, you will see the loan amount, you will see the LTV, you will also see the rate. The rate is going to be stated at either a fixed for a certain amount of time, or you can go with floating. You'll put an index plus margin. So in this case, we have the Wall Street Journal Prime as the index, and the margin is 1%. And then whenever you go with the floating rate, you will also have a ceiling and a floor. So ceiling will mean the highest, the rate that it can get over the term of this loan, and then the floor will mean the lowest that this loan will basically have as the interest rate. So here the ceiling is 9.25 and the floor is 6.25, or the borrower can go at fixed at 7.89% today.
Yeah, and that's important for people to review because that's how they kind of know what they have to be able to bear as far as their interest rate, right?
Yes, and whether or not they want to predict their finances over a certain period of time, because if the rate fluctuates consistently, then they cannot predict their cash flow, they cannot predict their income, and it causes a lot more challenges.
Yeah, that's why I think most borrowers prefer a fixed rate, unless, of course, you believe that interest rates are going to go down. But it's a very good point. You may have a floor anyway. So even if rates go down, you may not go below the floor.
Yes. And rest of this stuff is just basic lingo, legal lingo, nothing really into it. But so we just wanted to show you what a term sheet looks like. And one more thing to remember when you're doing commercial is this is not like residential where you get a 30-year fixed or a 15-year fixed or something of that nature. Here you will usually have um, an initial fixed period. So here we have a 5-year term, and you will have usually have a 25-year amortization. So what basically this 5-year term means is even though the monthly payment is going to be based on a 25-year amortization, this whole note will come due in 5 years. So at that point in time, the borrower will either have to redo the loan with the same bank, or they will need to find a new lender. And I did forget to mention about the prepayment penalties. This one has a 3-2-1 step down. So basically, that's what it means is if you refinance within the first year, your penalty will be 3% of the outstanding balance, lowers to 2%, and then 1%, and then no PPP thereafter.
Yeah.
So this is all about term sheets. Now we want to show you how to speak lender language. Before we do that, we want to show you an example of something so that way you understand why lender language is important. So on this same term sheet, we want to show you a snippet. Is when the bank was writing the term sheet, they wanted our borrower to maintain a minimum of $200,000 monthly balance. And our borrower was sophisticated enough to speak the lender language. So she was able to negotiate. And we want to show you an example of what a lender language looks like.
And
So,
why do they do that, Jay? Why do they ask for a minimum balance to be maintained?
well, the bank is accounting that minimum balance into their profitability. So if they know that this borrower is going to have a $200,000 minimum deposit with them at any given time, that means that the bank has access to another $200,000 in funds that it can use to generate more revenue for itself. So that's
Yeah.
why minimum balance requirements are important.
And also, just for our viewers, so banks have their own profitability models per customer and per deal. So when they ask for a minimum balance to be maintained or for additional deposit to be maintained at the bank, that all goes into that calculation. So if you want to reduce the balance that you're maintaining with that lender, then their profitability goes down and everybody has a certain minimum.
So on this one, as you can see, the buyer, she was able to negotiate her compensating balance from 200,000 to, we'll show you on the term. So initially the ask was 200,000. The borrower was sophisticated enough to speak the bank's language. So she asked for certain, she tried to renegotiate her term sheet. She asked for multiple things. Like Ms. Suzanne mentioned, the bank will take into account their different variables that goes into calculating their profit, and they will tweak it based on what they can offer to close the deal, basically.
Yeah,
So
and just so our borrowers know, that was important to this borrower. But in other cases, the borrower may be able to negotiate the rate even once the term sheet has been issued. Sometimes amortization, but prepayment penalty is often also what's going to be negotiated, especially with a portfolio lender. That's not unusual.
So as you can see, like, I mean, if you don't know how to talk to a lender, there's no way she would have got what she was able to get. Like even reducing the minimum balance from 200 to 100,000 is significant, especially for an asset that is on a fixed rental income model.
Yep.
And as you can see, she negotiated it down to, where did the 100,000? As you can see right here, initial term sheet had it for 200,000, and she was able to negotiate it down to 100,000. So I hope you guys enjoyed this video. And like we said, we're gonna provide you real stuff, real people, real deal, real stuff. That's it.
And Jay, you're gonna be talking about all the different parts of the lender language so that the borrowers can feel empowered, like when they get the term sheet and there may be a surprise, there may not be a surprise, but they feel they understand it and they can respond to it in a way that's meaningful to them.
Yes, and they should always be the one driving the conversation. So you cannot drive a conversation if you don't know what to talk about. So come join us.
Sounds good, Jay. Thanks so much.
Thank you.